Hi, I'm Neil Garfield, author and editor of the blog site www.livinglies.wordpress.com, which is a primary resource on the internet for people seeking information on foreclosure defense and mortgage litigation. Today we're going to talk about insurance. There are many forms of insurance that are involved in a mortgage transaction, and there's many more forms of insurance that are involved when that mortgage is securitized. Now, if you've seen any of the other videos, you know that a mortgage being securitized means that it's converted from just being an obligation, a note, and a mortgage or a deed of trust. It's converted from that to a security, which is sold to investors. So that's why it's called securitization. They sell a security. So you have the investor, who is the one advancing the funds from which the funding of the loan takes place, and the investor, therefore, is the creditor. And you have the homeowner, who is the one receiving the benefit of the funding of that loan, who is the debtor. So you have the creditor, you have the debtor, you have the investor, you have the homeowner. Now, let's look at the various forms of insurance, and you'll see why we're going to be talking about that in the context of securitized loans, because some very interesting things occur. First form of insurance that you probably become aware of at the time of closing is title insurance. And if you look to see who the beneficiary is in a securitized loan, under that title insurance, who's going to be paid, you might just find that the beneficiary of the title policy is different than the mortgagee or the beneficiary under the deed of trust. That alone creates a question of fact as to who the creditor is and who it was intended to be and who the lender is. And you will often find that there is that difference. Now, you also have property insurance, the deed of trust or the mortgage, both of which are classified as a security instrument. So if you hear me say that, you'll know I mean a mortgage or a deed of trust. The security instrument will often provide that the homeowner will insure the property in a manner where the lender is the beneficiary under that property insurance policy. So you compare the beneficiary under that policy with the beneficiary under the title policy with the beneficiary under the mortgage, and in some cases you may well find three parties so far that are involved, raising a further question of fact as to who the real beneficiary is, who the creditor is, and so forth. These things are inevitable consequences of securitization that was not properly thought through by the Wall Street geniuses who created this problem for us. Now, there's also PMI, the insurance that says if you die or are disabled, that the payments will continue to be made or a principal payment will be made. The question there is, who is the beneficiary of that policy? And one of the interesting questions that comes up out of that is, what happens when the ownership of the loan has changed? What notice, if any, is given to these insurance carriers that have issued policies? And you'll usually find, I think, that they don't receive any notice. So you've got all of these transactions that the pretender lenders are saying occurred, and yet when it came to the insurance, the title insurance, the property insurance, and the PMI, etc., that are unchanged, while they're insisting that there were changes in ownership and they have a right to foreclose. These things are, as I said, the inevitable consequence of securitization that was not thought out properly. But then you have more insurance. You have something called credit default swaps. And credit default swaps basically are contracts which are technically defined by federal law as not insurance, even though that's what they are, in my opinion, and technically defined as not securities, even though that's what they are, in my opinion. And what they do is they allow an investment banker to sell securities to an investor and at the same time bet that those securities go bad. So the investment banker was motivated to make sure that the package of securities that he sold to the investor would go bad. And the best way to do that was to make bad loans. So that's what they did. They created loans that, for example, had teaser rates that were within the income of a prospective borrower, but would reset to payments that exceeded the income of the prospective borrower. So they could be sure that at some point when this loan reset, that it would go into default, which is exactly what they needed, because they insured the loan pool indirectly through the securities many times over. And according to published reports, the number of times that they insured these mortgages may well have exceeded 30. So if you have a $300,000 mortgage, it's worth $9 million to somebody if it goes into default, but it's only worth $300,000 if you pay it. So they obviously have an interest in seeing you default. Then you have other forms of insurance through AIG and other types of entities that provided some hedge products or actual insurance contracts on the payment flow, which were not disclosed to you but were used where the money that was taken out in the yield spread, which I have already commented on in another video, they used the money taken out of your transaction to buy these insurance policies, and they bought them for the benefit of themselves instead of either the investor, who is a creditor, or the homeowner, who's a borrower, and didn't disclose it at all to either of you. And lastly, there is a form of insurance that arises as a consequence of what is called cross-collateralization and over-collateralization. Basically, cross-collateralization means that the proceeds of one loan are going to be used to cover the proceeds of another. So the payment stream of one loan is guaranteeing the payment stream of another.